folks. We're at the Baker Street Property Meet. We've just had a whole bunch of talks on how to scale your property business. We're here with 150 property entrepreneurs. You having fun, guys? Yeah! So we've heard from 3 speakers. Now, links to all the talks that have been done by Rod Turner, by Romey Chopra and Paul Oberscneider. They're all in the description below, so click on them, watch them, learn and be inspired. But what we're going into now is a bit of a Q&A, a question and answer. All our sort of audience have been listening and jotting down some notes, and they've got some questions to ask our panel, and that's what we were going to kind of get on to now. If you're new to this channel, make sure you subscribe, hit the bell icon. We release new content each week. It's all about helping you be more successful in property, so subscribe today. So, on to the Q&A panel. We've got our panelists up here. Who has got the first question?
The question is related to debt-equity ratios. There is a common theme about the market cycle and scaling your business sustainably. So with that in mind, what sort of debt-equity ratios would you suggest for SME developers at the moment?
I think that totally depends on really what the coverage is, how you can service it and how you can pay back that senior debt. So like I touched on there, you got rental stress test figures. So it doesn't matter if you go up to 90%, as long as your exits are covered and each of them can cover paying back that senior debt. So again, it all comes back to margin, how much margin you're going to get from it.
Paul, what are your views on that?
Yeah, I mean, as far as development, you know, as a lender, as a funder, you want to make sure that you have enough of a cushion to withstand any falls in GDVs. But, you know, we go to great pains to understand what that GDV might be. So we'll look at rental comps, we'll look at sales comps, we'll look at investment comps, we'll look at comps that are coming on the market, you know, what developments will we be competing with, and we'll take a view as to whether that GDV is solid enough, and then, you know, at 75%, you know, we feel that we have a fairly decent enough cushion that if things kind of go sideways a little bit, that we're okay. So it really depends on how solid those GDV figures are based on our underwriting.
And if I could just ask you to answer that debt equity question from a slightly different spin, because your bag is build to rent. Mm-hmm. So from a build to rent perspective, what's your views on the debt equity?
Yeah, I concur somewhat with Paul. I think most of my model is based on, most of my development is London Southeast, or predominantly Southeast around the home counties. So on that basis, we've fairly sort of well established market. We've done a fair amount of homework on that. So I think on that basis, we say 75% is where we're comfortable with, based on the fact that we've got very strong rental. We obviously have had a substantial portfolio of properties now which have confirmed what sort of rentals I'm likely to have over the last 10 years, and that gives me some degree of confidence with myself and obviously with any funding partner that we decide to work with going forward.
For a first-time developer, similar question to the other gentleman, but I'll ask it anyway. I've heard that it would be best to purchase a site up front and, you know, unconditionally without planning. Or how would you best structure the financial deal? You know, the mix between purchasing and loan to cost, etc.
For a first-time developer. For a site without planning.
Yeah.
Okay. Do you want to handle that? Because your site.
Yeah. The site, as I think when I was showing my presentation, the site we bought, we took the position that no guarantee when it comes to planning, and no guarantee in terms of the time it's going to take for you to get planning. So the question is the ability to hold that asset. So it could take 12 months, it could take 15 months, it could take 2 years. Question is, do you have the ability to hold that property for that period of time in your finance costs? So in our situation, we realized that we were having the ability to rent that property out during that planning process. So if for any reason it didn't get to planning, we have a fallback fallback option. So that's really, I would say, when you're looking at anything where there is potentially a potential planning situation, and that could be protracted, you've got to look at whether or not you're able to fulfill that time period and whether you've got something in there. And if it doesn't, then there is a fallback plan maybe that you can fall back in. That's how I would work on that basis.
Hi, Dale Gujral from 1996 Party Wall Surveyors. Question for the panel.
Why is it called party? There's nothing party about it.
Depends where you go though. Right, so where does the panel feel the next opportunity for developers will be?
Sorry, say that again.
Which is the area for next opportunity for developers? What's the area?
Well, I think that question really, it's a regional question. I think basically where we kind of see the best returns with the least risk is probably in the Northeast, in some of these markets. We're not looking at London quite so much. So we only do residential development, which is basically anything with a bed. Look at the regional markets. Now, if I take my residential hat off for a moment, just as a property developer, I like sheds, small sheds, as a development opportunity. I also like the senior, okay, we're back to beds. I like the senior care home sector quite a bit. I mean, we're an aging population, and I don't think anybody's come up with the right solution for that. But I would say in the regions predominantly.
Brilliant. Rob, do you have anything to add?
Yeah, I think specialist housing. So I think where you've got to look at is where the government's going to be spending money and where are they short on. And like Paul said, aging population. Also got disability as well. Again, it goes back to what's the product, what's the market, where's the opportunity, where are the government starting to make changes to credit, to legislation. A few years ago we had the old office to resi stuff. Now we've got some industrial units coming up. We've also got that shortage of office space. I think that's a really good opportunity. We've got an issue with the high street, clearly. Yeah, where lots of very cheap properties coming on the market. Can they be reused as something else? Yep.
Andy Newsham, I'm a property compliance bod. Okay, do a lot of asbestos surveying, fire risk assessments, that kind of thing. Very short question for Paul. The 35-page memo, who would provide that?
Who would provide the deal memo?
Well, back in the day, we used to write it ourselves. But as a funder, we do the majority of that work for our clients. So we don't expect you to know how to do that. We spend an inordinate amount of time on our own dime actually making sure that we're comfortable with the deal. We don't issue a term sheet until weeks after we actually get introduced to the deal because we don't believe in doing that. I mean, we could if we wanted, but we'll spend the time doing a desktop review first. We'll pull all the data points that we have, both public and private. We'll take a view on the GDVs. If we feel comfortable up at that point, then we'll go meet with the developer, the professional team on site. We'll look at the market, and then we'll start pulling all that together. And that's when you get the term sheet, and that's where you provide us with the undertaking to pay for the service or the professional team to actually go in and do the valuation and the QS work. So start to finish, it's probably about 6 to 8 weeks, but we actually write that credit paper on your behalf because the way our funding model works is we're providing 90% of the cost, so it's almost like it's our deal. Right? And we need to make sure that we're really comfortable with that deal. And if we kind of say no, you should probably think twice about it. So we provide up to 75% of LTGDV, which is quite aggressive. So we're providing effectively all the senior, the mezz, if you will, and probably about a third of the equity. So it's a lot of capital, which is why we take the time to actually do that work. As a developer, we understand you probably don't have the skill set to do that, and nor should you. I mean, your job is to build homes, right? Your job is to make sure that the project's executed. You know, you don't need to know your way around Mayfair and know where the Capitol is, and you don't need to know how to put all that together. That's what we do. You know, we're the guys that in the background do all that work. I hope that helps. Yeah.
I'm Amjad Rama. I'm a property developer here in London. My question is really about risk management, and Rod, you touched on it. Funding via limited company envelope usually attracts a personal guarantee from the director. What strategies can we put in place to minimise that risk to the director?
Well, it depends on the size of the project. It depends on your track record. So, first-time developers, yes, you're likely going to get a PG put on that. One of the things they might even come at you is asking for a debenture or a share charge. So, therefore, it's really important that you don't have other assets within that SPV. So each individual development, ideally you want to have it there. We can get complicated and start talking about kind of holding companies, having SPVs off there, and that group structure, but that brings with it other risks, such as limiting the amount of lenders that want to lend on that and moving that the asset within the companies. I would always say, if the deal's good enough, you'll be able to find a lender that will lend purely on the asset. But sometimes it means putting a bit more equity in. So again, it just comes down to how much you're willing to risk. Because remember, if your liability is for 20% of just the debt, you've got to look at your net assets and how long will it take you to wear that. Because essentially, if you finish a development, it's not going to be worth zero. Yeah, it's going to be worth something. So they're going to get back some of that debt. Yeah, so it's understanding really that risk.
I mean, as a first charge lender, you know, we don't, in most cases, we don't take PGs, but what we would do is we would definitely take guarantees on any cost overruns. So, you know, you'd have a PG on a cost overrun above a certain percentage, let's say 10% or whatever it is, you know, then we would require the developer to actually put in that equity. If the equity wasn't put in, technically, it's a default, you know, but because we're very much exit driven, we don't look to exercise that. We look to work with the developer because we want the project to actually get finished, but there would be a guarantee on cost overruns.
Yeah. I'll just say on our first project that we just did in Reading, there was a PG, but since we've successfully delivered that, on the second project that I've done in Watford, I wasn't asked for a PG. So I think what I would say to you is that your first one is always going to be the most painful, the one that's going to be a little bit more risky. But if if that's why the first one you choose carefully, get that across the line, get it through. It may well be that you may have to reduce your profit margin a little bit, but that could be your entry card to get into the finance game. And once they see that you've done that diligently, responsibly, with the right contractor, on time, on budget, I think you'll find that they will probably take a slightly different view on future projects.
Let me just add one thing. You know, at the end of the day, PGs are extremely difficult to enforce and probably not worth the paper they're printed on. And in fact, you know, when we do our KYC on a developer, we try to figure out how many PGs there are. There are guys out there that might have, 10 PGs on it. They don't even have that kind of money. So we look at the developer's balance sheet. We look at the director's balance sheet. We look at the company balance sheet. And most important to me is really from a first loss position, who's going to take the first loss? Well, it's got to be the sponsor, the developer, right? If you're worth, I don't know, 20 million pounds and you're going to lose 200 grand on a deal, you can walk away. It's a bad day, but it's not going to kill you. But if your net worth is 800,000 or $1 million and you lose a couple hundred grand, that's a bad day. That's a really bad day. So I want to understand the pain that as a developer, might experience if something goes off track, because I want your attention. I want you to be focused. I don't want you to just say, hands up, I made a mistake, and leave me holding the bag, right? So it really is all relative to who the borrower is, the KYC we do, and to me, that's more important than a PG. You know, do I think you're not gonna sleep at night? That's what I want. I want you to be thinking about your project all the time.
How much pain is optimal?
20% of their net worth?
It needs to be, every case is different. You know, it needs to be a significant number to make it meaningful, because what we're trying to avoid is the case where a project goes off the rails and, you know, the developer just decides to walk away. We just simply don't want that to happen. So it has to be meaningful enough, and that's an intuitive judgment, you know. And that's based on knowing the developer, visiting him, having lunch, meeting his family, maybe, you know, going to see where, you know, where he lives and what he's driving. We also do a lot of referencing. We look at social media, we see what they're doing in their lives, and we take a view on the guy. I mean, there are a lot of guys on social media today that we all know, I wouldn't give them a penny, you know, simply because these guys are high risk, you know, and they're going to crash. So we look at all this stuff, and technology has made all this information available. So, you know, that's what we do.
Hi there, my name is Nicholas. I'm from Princegate Chartered Surveyors. You mentioned the support team being very important. This is for Romey, by the way. The support team, that it can make or break a project. Now, this is very relevant to us because that's exactly what we are. We're a charter building consultancy, so we work with developers all the time. Yeah. What would you like to see improve from your support team? If you could custom build and tailor that team to your liking, what would you as a developer like to see?
Yeah, I would say, I think the quantity surveyors the costings is an area that I think definitely needs some degree of improvement, because that's an area which I have had particular challenges in our own project. I think one of the things as well is when you're designing any project from scratch, when you come in and you're sitting down, because the architect effectively designs your project, then effectively you get everybody else coming in to do, whether it's the structural surveyor or any of the other surveyors that come into play, or the quantity surveyor. The issue, I think, comes in that a lot of them tend to work remotely, and then a lot of them don't tend to come in together. So I think another room for improvement would have some of these professionals collaborate a little bit more effectively than they do. Because you work with one, then you move to the other one, and invariably what tends to happen is that if things go wrong, it's a question of then shifting the blame from one person to the other. So I would say that would be one of the key improvements I would see, that each have a role to play, and it can and some person's role could be more important depending on the type of project you're doing. For example, in the project I'm doing in Watford, there's underpinning, so the structural engineer has a particular role to play, but then he lives in Dorset and the architect lives in London, and they talk to each other on the phone, but they only meet once every 6 months, which I don't believe is actually a very particularly good way, because I need both of them to come on site, both of them to see what the problem is, and then both to evaluate rather than just looking at a screen or a piece of paper. So I think that's one of the key points I think is important, that there needs to be a lot more collaboration and a lot more sort of regular review meetings as a collective rather than individually.
Sorry, I just wanted to add to that as well. And 100% on what Romey says is getting everyone together, whether it's all on a monthly Skype meeting. But one of the keys for me is to make sure that my design team, and I'll include anyone operational in that, is to make sure that everyone is on the same page when it comes to the critical path of my development. And what I mean by that is which are the parts that can significantly hold up steps 3, 4, 5, and everyone needs to be absolutely clear on when those particular parts of the critical path need to be delivered. And if I am going to take on a new structural engineer, what I want to know, what I must know, is their quality management control. Okay, what system do they use? how do they ensure that things get done on time? Are they using Podio, Asana, things like that? If they say they haven't got one, or they just use a spreadsheet, I'm really not interested in using them.
We just want to find out from the panel what they would kind of recommend, or not quite recommend, which lender for a first-time developer is kind of a bit easier to kind of work with on that side. I know it's
Lendy probably was.
Yeah, sadly they're gone.
I think that's kind of it's a hard question to answer because there's so many variables depending on the deal, who's in your team. But I mean, there's lenders out there that will lend on anything and be flexible, but you're going to pay for it in their rates. It's dependent.
Yeah, I think one of the things that we sometimes see are, guys that have built like 2 or 3 units and then come to us and say, well, we'd like to build a scheme of 60. That just doesn't work for me. We need to see a track record. And I think as a developer that started out building single units, you build a track record. You build one, then you build another, and you're using your own money and you're putting your profit back into it, and maybe you leverage a little bit, and then the next time you leverage a little bit more. I mean, all this stuff isn't overnight. And I think that's one of the things that everybody has to kind of get. And you build up to a level where then when you go in to see a lender, you pull out your portfolio and you say, this is what I've done. And it gives a lot of comfort. So I think you have to build yourself and work up to a level. And if you're just starting out, as my colleague here said, there are lenders out there, and you might not get the best terms, but it'll get you started. I mean, the high street banks can't lend because of the capital requirements, but there are plenty of alternative lenders out there, and there are peer-to-peer lenders too that are in the market still, lending quite aggressively. So I'd go there. They're not going to have as a robust underwriting program as we do, because they simply don't have the infrastructure to do that or the time. So they'd probably be the easiest to go to.
Romey, I remember you saying to me you're considering peer-to-peer on a future project. Do you have any thoughts as to, or can you share why you're considering peer-to-peer?
I think one of the principal reasons I'm looking at that is the sort of banks and any of the financial institutions, some of the sort of intangible costs that come in, whether it's administration fees or interest charges and things. There's a lot of hidden costs with some of the institutions which eat into your profit margin. So with the peer-to-peer lending, the cost dynamics are fairly fixed, and so you know where you're at. So I'm looking at projects now where we can potentially look at that. I believe now that, I look at hybrid type of lending now. So you can have a bit of a mixed bag in terms of how you fund a project. And when you look at when we first started, and I went through the same probably painful process as yourself in looking for the right lender, it's go in there. If you do your homework and you've got your numbers right, and it's about selling yourself to a lender and building up that sort of confidence with them. Because at the end of the day, they're taking a risk on you, and so you've got to convince them that you are an investable individual and that you can deliver. As I said, as my colleagues have said, that when a bank is looking to invest a large sum of money, they need to be sure that you're going to be able to deliver at the end point. So I think the peer-to-peer lending does give you an alternative, particularly if you're looking to start the process. So start small, even if it's a £100,000 project or a £200,000 project. It's worth starting that and getting the wheels in motion. The key thing is just get on and do it. That's the advice to give anyone in the room, whether it's a £100,000 project or a £1 million project. Take the initiative and start with the easiest form of lending that you can achieve. Get that delivered. Do a few of those, and then you've got a fighting chance to move up the scale and take something big.
Record and trust.
Yeah.
I mean, a very good. Do you know Crowd Property? They're very good at what they do. So somebody like that, I'd start there.
My question is, we have talked a lot about sort of how to find the lender and how to get it, but my question is what should a developer be looking when they are trying to choose a lender? Let's say they have few options, but what are the certain things that they should be careful about and they should consider when deciding on taking on board a lender and taking the money from a lender?
So
Thank you.
it's looking very carefully at that term sheet, understanding all other costs. So things like, what are their legal costs? Is there a legal admin fee? Is there an entry cost or application fee? Is there an exit fee? Are there any penalty fees? Yeah, and when do they kick in? Early redemption charges. Okay, so it's all these extras that can actually take something that might be, I don't know, 7% annually, and that could creep up to actually being about 11 or 12% annually. So it's really important to understand what those charges mean and adding them up. But yeah, legal ones are often ones that get missed, especially on the smaller loans, because it's a bigger percentage of that loan. For example, you might need a legal charge for a PG. You might need a legal cost for, what are they called? When you sign it to say you understand what the PG is, it's like a guarantor form. You've got legal charges for the lender, legal charges for yourself, and also they could add on admin fees on that as well. So it's just important to understand that from the outset, and sometimes even poking that lender to ask them what they are.
Underlining everything that Rod says, but if you've got offers from more than one lender, don't be afraid. Nothing's cast in stone. Go back to them and say, no, this guy's not charging me this. What are you going to do about it? And I always do that. You know, just play them on off and get the other, reduce the terms. So-and-so is not charging this. I'm not really interested in yours. It's unattractive to me. Normally they ask to see the paperwork, you show it to them, and then you find they consult a few people and it gets chipped away. So it's a negotiation, yeah? Understand it, negotiate it.
Yeah, I think that, you know, we don't like the Mexican bazaar routine. You know, which is why we spend a lot of time up front that we do it on our dime. And when we give a term sheet out, we ask for a commitment, because what we don't want you to do is take the 3 to 4 weeks that we've just spent doing your deal and then having you go shop it around. So there needs to be a point where, you know, there's a decision taken on both sides. But at the end of the day, this is a people's business. You know, go to their office, meet with them a couple times, have them come to the site. There needs to be some sort of chemistry, because when things kind of go wrong, it's a bit like a marriage, right? You need to be able to work things out. You don't want to have a rapacious lender that just triggers a default just because he can. You know, you want to be able to go in and see that person and talk to them and be aligned with that lender, which is where I think we're quite unique. You know, because our model is so defined at the exit that we're actually quite aligned with our partners, with our developers. We want the same thing. So, you know, unlike a lot of traditional alternative lenders even, you know, we have just a different mindset. So the relationship to us, as it should be for you, is quite important, because we don't want to lend you money and then a year later have you go somewhere else. We want to lend you money, and we want to lend you money again and again and again, because at the end of the day, for me, I'd rather have 30, call it operating partners in the market, than 1,000 loans out. You know, because I can help you grow and scale your business. As you grow and scale your business, I grow and scale mine. And that's a partnership.
Yeah. Like that. Huh.
If you enjoyed this video, hit the like button. If you're not a subscriber, what are you waiting for? Subscribe, hit the bell icon. As soon as we upload, we'll let you know. And enjoy these. They're all dedicated to helping you be more successful in property. Happy investing!